Right, welcome to our YouTube channel. So we are into part 3 of capital allowances. So without any waste of time, let's get into the session. So in terms of the focus for this session, we are looking at leases and intellectual property. Right, so in terms of leases, we're going to start off by looking at lease premiums in terms of section 11F. Before we then look at the allowances that are there or deductions that are there in terms of section 11F, let's firstly recap in terms of gross income implications. Remember, we said that the lessor will include the full amount in gross income in the year of receipt or accrual. This in terms of para G of the gross income definition. Right now, when we look at the lessee will be eligible for allowances in terms of section 11F. So the allowance is calculated as follows. You'd say the total premium paid divided by the number of years, limited to 25 years, right? So these allowances are apportioned for part of the year. To give an example, let's say the lease agreement was concluded and commenced on maybe during the year, maybe let's say 6 months into the year. All right. So for that year of assessment, then the lessee will get a deduction, but the deduction will be then obviously then apportioned for the 6 months of the year that the lease was effective. All right. So as part of then the number of years of this lease, if the lease contract includes renewal options, then we are going to then consider if it is probable that the lessee will renew the lease or not. If it is probable, then the renewal period will be included as part of the lease term. All right, so renewal periods are included. All right, then what happens if there's an early termination of the lease? So the legislation says allowances are claimed up to the period of termination, meaning that any allowances that were still to be claimed beyond the date of termination then will not be claimed. All right, so basically then these allowances or the balance then is forfeited. All right. um, then let's move on to then section 11G, leasehold improvements. All right, again, let's recap in terms of the gross income implications. Remember, we said the lessor includes the value of the improvements in gross income in the year that these improvements are accrued to the lessor in terms of para H of the definition of gross income. All right. Then when we look at then allowances that are available to the lessee, so the lessee basically then will get allowances in terms of section 11G, all right? The allowance is only available when the lessee is obliged to effect improvements, meaning that this has to be stated in the lease agreement. So it could be stated explicitly or it could be implied, right? Then this means then the value of the improvements would constitute gross income for the lessor. So as long as then the value of the improvements constitute gross income for the lessor, then the lessee then will be eligible for allowances in terms of section 11G. Right? How do we calculate the allowances? We're going to take the value of the improvements, right? So we did discuss what the value would be when we're looking at gross income special inclusions. So if you don't know the value that we will take here, then you need to go back there and basically just brush on the principles. All right. So we will say the value of improvements divided by years of use. Here we are saying years of use. We need to be very careful here. All right. So when you're dealing with leasehold improvements, right, as the lessee is still busy, effecting the improvements would not be then brought into use. They can only be brought into use once they are completed. All right. So meaning the period of use here, we are referring to the period when the leasehold improvements are completed and basically these improvements are brought into use. So you will count from the date when these improvements are completed and brought into use up to the end of the period of the lease. Again, you limit it to 25 years and these allowances are apportioned for part of the year. Again, renewals would be considered when we determine these years of use. If it is probable that the lessee will renew, then the renewal periods would be included as part of those years, right? There is an NB, I think I've already then spoken to that, to say the number of years is calculated from the date on which improvements are completed, but limited to the maximum period of 25 years, right? So then we are saying the allowance is limited to the amount stipulated, right? So if the lessee spend more, then obviously then the allowance will be based on the stipulated amount. For example, let's say the lease agreement says the lessee must spend 500,000 and the lessee spends 700,000. So then the Section 11G allowances then would be based on the 500,000 that is stipulated in the lease agreement. And then the excess of 200,000, we will speak to the implications in the following slides, all right? Then if the lessee spends less than the stipulated amount, then the Section 11G allowances would be based on the actual cost, right? So in this case, let's say they have spent 400,000, then the allowances would then be based on 400,000 and not 500,000 as stipulated in the lease agreement, all right? If the amount is not stipulated, remember, then we said you can then use the fair and reasonable amount, all right? Right, so now let's speak about that 200,000, which is an excess amount over and above the 500 that was stipulated, so the 200,000. So the allowances would be based on 500 in terms of Section 11G, but then the lessee can claim allowances under Section 13 on the 200,000 excess. So except for Section 13 Queen, meaning that they can claim allowances under either Section 13(1), which is allowances for manufacturing buildings, or Section 13 6 that provides allowances for residential units, right? So, but obviously then what is going to decide the section that is applicable would be then what improvements did the lessee effect. So let's give an example. So if the lessee leased land, and then in terms of the lease agreement, the lessor said you must build, buildings on this land, then we're going to look at this building or buildings and see what are they going to then be used for. If they're going to be used for manufacturing purposes, then that 200,000 would be then claimed under Section 13. So you would say 200,000, and then you claim 5% per annum. All right. If the buildings that are supposed to be then constructed or erected by the lessee are residential units, then the 200,000 would be claimed under Section 13(6). All right. But remember, now there's an NB there that the lessee can choose between Section 11G and Section 13, but this relates to the 500,000, the amount stipulated, to say, well, in terms of the access, remember, there can't be that option because Section 11G says you claim up to the stipulated amount. But then the 500,000 itself, the stipulated amount, the lessee has an option between Section 11G and Section 13, right? So then what is going to then drive the section that the lessee uses? Obviously, they will use a section that provides the best benefit to them, right? So you can determine this by looking at the period over which allowances then will be claimable, right? So basically, you look at the lease term, right, compared to the write-off period under Section 13. So Section 13(1), remember, the allowances are 5%, meaning that the period of write-off is 20 years, right? And then Section 13(6) really has two periods there. If it's just normal residential units, then the rate is 5%, meaning it's 20 years. Then if it's low-cost residential units, remember there's an additional 5%, meaning that allowances then are based on 10%. Then the write-off period there would be 10 years, all right? So you compare the lease period to the years under Section 13, right? So if the lease period years are basically lesser than the years under Section 13, the lessee will always opt for Section 11G. But most of the times, it's the case that the lease period is less than the years under Section 13, right? But in those cases where then the lease really is for a very long period, then the lessee might have to then opt for Section 13 rather than claiming allowances under Section 11G. Right. Then what happens if there's an early termination? So the lessee will be allowed to claim allowances for the year in which the termination occurred, right? But then what happens to the balance that is remaining beyond the date of termination, the lessee will also be then allowed to claim that in the year of termination. So the balance doesn't fall away. It's not forfeited, as opposed to what we've seen under Section 11F. Right. So if you want more details on leasehold improvements, you can refer to Interpretation Note 110. And then for your lease premiums, you can refer to Interpretation Note 109. All right. So let's quickly look at an example. So in terms of leasehold agreement of land, builder who's the lessee has to erect a factory for the sole use in its manufacturing operations. So we already know the type of improvements the lessee will effect. So it's building the buildings that are going to be used for manufacturing purposes. So if they are going to in turn excess amount over what is stipulated in the contract, then we definitely know that that access, then the lessee will claim allowances in terms of Section 13(1), right? So the value of the improvements were stated to be 3 million, and they said these improvements must be effected within 18 months from the date of commencement of the lease, which was the 1st of January 2025. The lease is for a period of 20 years, all right? Um, so you need to be keeping, track of these dates, right? And the amounts, because also you need to know if they've spent the stipulated amount or more or less. So you need to be keeping track of this information. So the lease period is important. The time that the improvements were taken to be completed is important. The amount stipulated and the amount actually spent, all these are important. All right. On the expiry of the lease, the factory will revert to the landlord without compensation to builder. All right. At the end of the first year of assessment, that was 30 June 2025, the factory had been completed, but had not been completed. All right, so they're still busy with the erection of the factory, right? But 1,250,000 had actually been spent on its erection, right? So you just need to keep track of the costs and keep, supporting information, including invoices, so that once then the erection is completed and you bring this into use, then you can claim allowances, right? So in case then SARS requires proof, then you will be able to furnish such proof, all right? The building was completed on 31st March 2026 at a total cost of 3,500,000. So they've spent 500,000 more than the stipulated amount. So the 500,000 would qualify for allowances under Section 13(1), right? So it won't qualify for allowances under Section 11G, right? And the factory was immediately let to tenants that also carried on qualifying manufacturing trade. All right. Calculate the allowances to be granted to builder in terms of Section 11G, as well as any other allowances for which the factory may qualify. Right, so let's start with obviously the value that we are going to use for Section 11G. So we are going to use 3 million, not 3.5. The 500 would qualify for allowances under Section 13(1), right? Then let's look at the years of use, right, which we need to divide the 3 million with. So we are not going to divide by 20 because that is the lease period. So we're going to divide by the period when the improvements then were, brought into use, and obviously then over the period until the lease ends. So we're going to count from when the improvements or the erection of the factory was completed and until then year 20, right? So the the improvements were erected from 1 January 2025 and they were completed on 31st March 2026. So we need to count the period that has elapsed. So from 1 January 2025 to 31st December 2025, we have a full 12 months period there. So it's 12 months. And then in the 2026 year, then they took January, February, March while still erecting the factory building. So that is only 3 months. So meaning that 15 months has passed. So 1 year, 3 months has passed, right? So meaning the remaining period essentially then is 18 months, 9 months, right? I mean, 18 years and 9 months that is remaining. So that is the period that we need to use, right? But remember, you can't say now divide by 18 years 9 months. So you need to essentially then convert the months into years, so that then you are having then the whole then period in denominated in years rather than years and months. All right. So what you will do is that you will say 9 divided by 12, and then you add that to 18. Then you will have 18.75. That is the period that you can use now to then divide the 3 million with, and then you can then now basically then calculate the allowances. And remember, the allowances are apportioned for part of the year, right? So then for other people who basically then would want to follow another approach of calculating the period remaining, I would fall into that group as well, where I have a period that is not constituted of. Just give me a minute. Right, I think I wanted to sort out something, but it's fine. I'll attend to that later. All right. So where the period that has elapsed is basically not constituted of 12 completed periods. Like in our case, we have one 12 months completed period, but then we also have 3 months which are not, a 12 completed period. So maybe it could be easier for one to basically then deal with months. So what I would do is to say, well, I would then say the lease period is 20 years. I'll multiply that by 12, and then have the period basically in months. So it would be 2012 times 12, then that would be 240 months. So that is the lease term. And then I'll basically say then the period that has elapsed is basically 15 months. So if you take the 15 and then you minus it from the 240, then you are remaining with 225 months. Then that would be the period that you can use then to say these are the years that in months, that is the years for use that you need to then divide to that value with. So I think other people can go for that. I would also then opt for that rather than basically then converting the 9 months into years and then adding that to the 18 years. So, but I think you will choose what works best for you. For me, I would say, well, I will say 3 million divided by the period remaining in months, because for me it's easier. I don't have to remember to convert the 9 months to years first, because everything now is represented in months. So I would say 3 million divided by 225, right? Then it would give me the allowance in months. So that would be just for 1 month. And then I will look at the year of assessment that I'm currently dealing with to see how many months then do I need to consider, or how many months was the improvements then brought into use in the current year of assessment. So for the 2026 year of assessment, that would only be 3 months. So it would be April, May, and June. So basically, then I would say then times 3. Then I would get my Section 11G allowances for 2026. All right. And then for the other years beyond 2026, then basically I would say 3 million divided by 225, then times 12 to show that basically the improvements were used for a full 12 months period. And then in the last year of the lease, then obviously the period there wouldn't be 12, because remember, in the first year of claiming allowances on these improvements, we basically then claimed only for 3 months. Then it means in the last year of assessment, or the last year of the lease, then you won't claim for a full 12 months period. I think that is one thing that you always need to keep at the back of your minds. And then for the people who are working with years, basically then they would have said these 18 years, 9 months that are remaining, then they would have said 9 divided by 12 to convert the months into years. And then they would have added that to 18, and they would have had then 18.75 years. Then they would then say 3 million divided by 18.75, right? So that would give you the allowances in yearly terms. So it's for a period of 12 months. Then for the 2026 year of assessment, because now we need to calculate allowances for only 3 months, then you still need to multiply by 3 over 12. Right. Then for the other years, then you basically just divide by the period, then you already have the amount in yearly terms. All right. So I think I would have then, explained, this example in detail. Let's quickly then go through the solution just to see what they have here, right? So when you look at the solution, then for the 2025 year of assessment, because the the improvements were still being constructed, nothing will be claimed there. And then for the 2026 year of assessment, you can see there they are saying that well, then they are saying the lease expires, so the remaining period in 3/4 years. So 3/4 is basically 0.75. So it's 18.075. 18.75. So that is what that represents. On your calculator, you can type 18/3/5. Well, maybe some smart calculators, but your basic calculators, you can't type that. You still need to convert the 3/4 into years. So basically 3 divided by 4 is 0.75. When you add it to 18, is 18.75, right? So they follow the approach of years. I would have followed the months approach myself. So then they say the allowance for the 2026 year of assessment is 3 million divided by 18.75, then times 3/12, what I've explained. All right. Um, but if you were dividing by months, then you would have to multiply by 3 and not divide by 12, right? And then for the other years, you simply divide by that period. And then in the last year, you then basically then have to apportion, right? There it's 6/12, right? And then the 500,000, like explained, you can see here they're applying 5% in terms of section 13(1). All right. Now, remember the section 13 allowances basically are 5%, so I mean it's 20 years. And then when you look at then section 11G, the 3 million would be written off over 18 years and 9 months. So that is less than 20 years. That's why now you're not even going to consider then providing allowances on the 3 million through section 13 because section 11G is favorable. All right, great. Then let's look at then relief that is there for lessors in terms of section 11H, right? So we are saying this provides a special allowance to lessors in special circumstances. What are those circumstances? We are saying the lessor included amounts in gross income in terms of para G, lease premiums, para H, leasehold improvements. So they include the full values, whereas the lessee was only claiming allowances over a period of time, right? So the lessor really is in an unfavorable position because they included the full value in 1 year, right? While the lessee is getting allowances over a period of time, over the lease term, right? So SARS then is quite aware of this, and then they said, we will provide relief for the lessors. That's why then we have section 11H, right? So the onus is on the taxpayer to prove the special circumstances. So this is in terms of interpretation notes 109 for lease premiums and 110, 110, so for leasehold improvements, right? Basically, then we'd have to write to SAS and say, well, I've included amounts in terms of para G, lease premiums in my gross income, or in terms of para H, or both really. So I'm seeking relief. So these are the special circumstances, right? So the allowance here then is the amount included in gross income, right? Either in terms of para G or para H or both, right? So the allowance is the amount included less the present value of that amount. So a very, very, very basic, calculation really. Then the legislation says use 6% basically to discount this amount. So the amount included becomes a future value. Then N is the period that the lessee would have used to calculate the allowances under section 11G and section 11H, right? So basically the lease period, if you are dealing with lease premiums, and um, then well, also then you look at then the remaining period if you're looking at leasehold improvements, but limited to 25 years. Then your interest, I would be 6% as provided. Then you then simply compute a present value. Basic calculation. think you guys already know how to calculate present values. You would have calculated present values from first year really. So in business calculations, you would have calculated present values. In accounting, you're calculating present values. In finance as well, you're calculating present values. So this is something that you are very good at. All right. So in tax, sometimes these present values would be provided. So because we just want to basically test the tax principles, we want to know if you would know that you have to then take the amount included in gross income minus this present value to get to the allowance in terms of section 11H, and then you provide that amount as an allowance. Sometimes maybe we might just expect you to still calculate the present values so that then we are integrating these modules, because sometimes integration is very important in well, obviously the type of qualifications that you're doing. Accounting integration is very important really. So you can see then to the right or side of the slide that there we just have an illustration there of this calculation. We are saying the amount included in gross income less present value of the amount included equals the special lessor's allowance in terms of section 11H, right? Here's an example. Let's quickly go through it. So we are saying lessor limited lets premises to Mr. Lessee for a period of 5 years with an option to renew the lease for a further 3 years. The lease forces Mr. Lessee to effect improvements to the land to the leased premises to the value of 1.8 million. The commissioner regards the duration of the lease to be 8 years, so it has taken into account the renewal period, right? Show the effect of the improvements on the lessor's taxable income, right? So we are saying just the lessor. You don't have to then focus on the lessee's implications, right? So the lessor, remember, they will include the full value in gross income, so the 1.8, but then now they also have a deduction in terms of section 11H, so the relief. So we say the relief is basically the amount included, which is the 1.8 less the present value of that 1.8. All right. So how do we calculate the present value? Future value would be the 1.8. Then R is the period, which is 8 years, including the renewal period. I would be 6%, so the interest. Then you can compute PV. Then the PV would be 1,129,342. So you'll basically then less that from the 1.8, then you get the relief amount, which is 670,658 rands. Right. So basic, very, very basic. Right. It's just a matter of you identifying when there is, a relief for the lessors. The calculations are really basic, really. Right. Okay. Then let's then move to intellectual properties. All right. So we are about to wrap up. So the allowances that are there, or deductions or allowances relating to intellectual property, right, will be driven by whether you are renewing or registering the intellectual property or you are purchasing it, right? So when you are registering or renewing intellectual property, Section 11 G Cap B will be applicable, right? And when you are acquiring intellectual property, Section 11 G Cap C will be applicable. So let's start off with Section 11 G Cap B, registration or renewal of intellectual property. So we are saying this applies to expenditure incurred on or after 2 November 2006. So it covers, the granting, the restoration, the extension of patents, the registration, the extension of designs, the registration or renewal of trademarks, either in SA or in foreign countries. So the condition, meaning the requirement, is that the intellectual property must be used in the production of income, right? The implication then, if this is the case, uh, you are basically registering or renewing any of those listed intellectual properties, then you will get a deduction. Remember, a deduction is 100% of the expenditure that you incurred, right, in the year that the intellectual property is brought into use in the production of income, right? Then if you are acquiring the intellectual property, Section 11 GCAPC applies. So we are saying it applies to expenditure incurred from 1 January 2004. So on or after 1 January 2004, right? It covers acquisition and not the creation of the following inventions, patents, designs, copyrights, or similar property. So trademarks are not included here. So we are saying excluding trademarks. So essentially, we are saying trademarks, uh, only have allowances or deductions if you are registering or renewing them. If you are acquiring them, basically, then there are no deductions or any allowances, right? So, and also knowledge that is essential to use any of these assets qualifies really. If you are purchasing a knowledge to use, for example, inventions or patents, then you will get a Section 11 GCAP C, deductions or allowances. All right. So it must be used in the production of income, as we have seen under Section 11 GCAP B. So what are the implications? If expenditure is not exceeding 5,000, then you get 100% deduction in the year brought into use. If the expenditure exceeds 5,000, then you will have to consider if you are dealing with patents, inventions, or copyrights. And if that is the case, then you get 5% allowances per annum. And then in the case of designs, you get 10% per annum. All right. These are not, the allowances are not apportioned for part of the year, right? The deduction or allowance commences in the year the asset is first brought into use, right? And then that note there, I would have already discussed that the fact that trademarks, if they are, purchased, then the taxpayer does not get any deductions or allowances, right? So this brings us to the end of the session. Thank you very much for tuning in. If you have any questions, please do post them in the comments section. And as always, remember to click subscribe and share and like the video. Thank you very much for tuning in. I will see you guys then in the next session where we are then wrapping up on this topic. So part 4 of capital allowances. Thank you very much. I will see you guys in the next session. Bye-bye.